If you're over 60, the game has fundamentally changed. Yet the financial industry is still selling you the same growth strategies they pitch to 30-year-olds. This is a trap. In 2022 and 2023, this trap snapped shut. The traditional 60-40 portfolio lost 18%, destroying retirement plans globally. Ray Dalio calls this sequence of returns risk, and it's the #1 reason retirees run out of money. Today, we're breaking down the 5 principles Dalio built not to make you rich, but to keep you from becoming poor when it matters most. Ray Dalio spent 50 years managing $160 billion, and these are the lessons that nearly destroyed him before they saved him. Dalio learned this lesson the hard way. In 1982, he made one of the most catastrophic predictions of his career. He believed the U.S. economy would collapse into depression. He was so convinced that he testified before Congress. He told clients to position defensively. He went all in on his thesis. He was completely wrong. The economy recovered, markets rallied, Bridgewater lost money, clients left. Dalio had to borrow $4,000 from his father to pay bills. He nearly lost everything he had built. At 33 years old, he faced total failure. But that wipeout taught him something that would define the rest of his career. Being right is not enough. You must structure your portfolio to survive being wrong. This insight became the foundation of his all-weather portfolio strategy, a portfolio designed to perform in any economic environment, not to maximize returns, but to minimize the chance of catastrophic failure. That same principle applies even more urgently to investors over 60. You do not have time to recover from devastation. Your portfolio must survive both your mistakes and the market's mistakes. The first principle is absolute capital preservation. When you are young, investing is about growth. You can take risks because you have decades to recover. Volatility helps you because you are buying regularly at different price points. A 50% market crash actually benefits you during accumulation. You purchase more shares at lower prices. When markets recover, you end up wealthier. But when you are over 60 and drawing money from your portfolio, everything inverts. That same 50% crash is devastating. You were selling shares to fund living expenses. You were selling at depressed prices. You were depleting your principal at exactly the wrong moment. And you may not have enough time for full recovery before you need more money. This is called sequence of returns risk, and it destroys more retirements than any other factor. Let me tell you a story that illustrates this with painful clarity. 2 brothers retired with $1 million each. The first brother retired in 2000, right before the dot-com crash. His portfolio dropped to $600,000 in the first year. He kept withdrawing $50,000 annually because he needed it to live. By the time markets recovered in 2007, his portfolio had been permanently impaired. Then 2008 hit and destroyed him further. He ran out of money at age 82 and had to rely entirely on Social Security. The second brother retired in 2008, also facing an immediate market crash. But he had structured his portfolio based on Dalio's principles. He kept 3 years of expenses in Treasury bills and high-quality short-term bonds. He did not have to sell stocks during the crash. He drew from his safe money while patiently waiting for equities to recover. By 2013, his stock allocation was back to its starting value. His portfolio was intact, and he still had decades of runway. Same starting point, same withdrawal needs, same market returns over time. Completely different outcomes because of structure and timing protection. If this resonates with you, take 30 seconds right now to write down your current portfolio on a single page. Every position, every account. If you cannot do it from memory, your portfolio is too complex. That is your first action step. But there is another side to this story. Bridgewater once worked with a widow in her 70s who watched her portfolio drop 20% in 2008. Against all advice, she liquidated everything and moved to cash. She could not emotionally handle the volatility. She stayed in cash for 4 years while markets recovered. By the time she felt comfortable reinvesting, she had permanently lost 40% of her purchasing power to inflation and opportunity cost. This taught Dalio something crucial. The best portfolio is not the one with highest theoretical returns. It is the one you can actually stick with during crashes. Emotional capacity matters more than mathematical optimization. Hold enough stable assets that you never have to sell stocks at the worst moment. This might mean 30 to 40% in Treasury bonds, TIPS, or short-term investment-grade bonds. Yes, this reduces your upside during bull markets, but it prevents catastrophic failure during bear markets. Would you rather earn 7% annually with minimal downside risk or chase 10% with a 20% chance of running out of money? The extra 3% is not worth it when failure means financial devastation. The second principle is ruthless simplicity. Complexity is the enemy of understanding, and understanding is the foundation of confidence. When markets crash and you do not understand why you own what you own, panic takes over. You make emotional decisions. You sell at the bottom. Dalio spent his career building sophisticated models with dozens of variables and hundreds of positions. Bridgewater runs some of the most complex quantitative strategies in the world. But for individuals, especially those over 60, that complexity is usually counterproductive. The evidence overwhelmingly shows that simple, low-cost strategies outperform complex, expensive ones over time. The S&P 500 index beats roughly 90% of active managers over 15-year periods. Not because indexing is brilliant, but because it avoids fees and behavioral mistakes. For retirement, pair equity exposure with simple, high-quality bonds. Maybe 60% in a broad stock index and 40% in intermediate-term Treasury bonds. 3 to 5 total positions maximum. If you cannot explain your entire strategy in 2 minutes to someone with no financial background, it is too complex. The third principle is building sustainable income streams. At 60, you need cash flow now, not capital appreciation that might materialize in 15 years. You cannot wait. You need money every month to pay bills, to maintain your lifestyle, to live. This makes dividend-paying stocks and bonds incredibly valuable. A company that pays dividends is giving you cash regardless of what the stock price does. You do not have to sell shares to generate money. The income arrives automatically. Combine dividend stocks with bond interest and you can potentially generate enough income to cover basic expenses without ever touching principal. Suppose you have $800,000. You allocate $480,000 to dividend stocks yielding 3% and $320,000 to bonds yielding 4.5%. The stocks generate $14,400 per year. The bonds generate $14,400 per year. That is $28,800 in income without selling anything. Add Social Security of roughly $20,000 and you have nearly $49,000 before touching principal. What is your number? How much annual income do you need to cover essentials without touching principal? Comment below with your target. Seeing other people's numbers helps everyone calibrate their own planning. The fourth principle is strategic inactivity. This might be the most counterintuitive lesson from Dalio's career. He runs a firm built on constant analysis, daily trading, and active management. But for individuals, especially older investors, the best decision is often no decision. Dalio experienced this principle dramatically in 2010. He bet heavily that the European debt crisis would trigger immediate economic collapse. He was intellectually right, but operationally wrong on timing. Bridgewater lost money. Clients questioned him. The media criticized him publicly, but he did not panic and reverse course. He stuck to his principles. Within 18 months, his original thesis played out. European bond yields spiked exactly as he predicted. The portfolio recovered all losses and more. But more importantly, the clients who stuck with him through the criticism gained something priceless. Proof that principles work even when they are temporarily painful. There is a famous study from Fidelity that analyzed which accounts performed best over a decade. The top performance belonged to people who forgot they had accounts or who had passed away. People who literally could not trade outperformed active managers. This is not a joke. The more you trade, the worse you typically do. Why? Because human psychology pushes us toward wrong actions. When markets crash, fear overwhelms us. We sell at the bottom. When markets soar, greed takes over. We buy at the top. When researchers examined why debt accounts performed best, it was not just about avoiding bad trades. It was about avoiding fees. Every transaction cost money. Every advisor consultation cost money. Every rebalancing created tax events. The deceased investors paid zero fees for years while their accounts compounded. Meanwhile, active investors paid 1 to 2% annually in various costs. Over a decade, that fee difference explained most of the performance gap. This study changed how Fidelity itself advises clients. They now explicitly tell retirees, the best thing you can do is set a plan and automate it. Your job is not to optimize. Your job is to avoid destroying what you have built through emotional decisions. Here is a challenge. Try going one full week without checking your portfolio. No apps, no websites, no news. Just 7 days. If you cannot do it, that tells you something important about your relationship with money. Post in the comments if you are taking this challenge. The fifth principle is conscious legacy planning. When you are over 60, you must think seriously about what happens to your wealth after you are gone. This is not just about tax minimization and legal documents. It is about preparing the next generation to handle wealth responsibly. Money without wisdom often does more harm than good. Dalio has spoken about difficult conversations with his children about inheritance, not about the amount, but about the responsibility. One of his sons once told him he felt intimidated by the family wealth, like he could never build something meaningful on his own because anything he did would be dwarfed by the family fortune. That conversation changed everything. Dalio stopped discussing inheritance amounts entirely. Instead, he started discussing problems. He would present his sons with business challenges Bridgewater faced and ask for their solutions. Not to use the solutions, but to teach the process. His greatest legacy became not the money, but the ability to think clearly under pressure. An heir who inherits $500,000 and blows it in 5 years receives nothing of lasting value. An heir who inherits $300,000 plus wisdom about money may be set up for a lifetime. Have the difficult conversations about end-of-life care. Who has power of attorney? What medical interventions do you want? These discussions prevent enormous family conflict later. Now for specific tactical recommendations. First, reassess your stock allocation honestly. The old rule was subtract your age from 100. At 65, that suggests 35% in stocks. This may be too conservative if you have substantial assets and good health, but the direction is correct. Your equity exposure should decline as you age. Someone with ample assets might stay at 50 to 60% stocks even at 70. Someone with limited assets might go to 30% at 60. Second, hold at least 3 to 5 years of spending needs in stable assets. This is your insurance against sequence of returns risk. If you spend $40,000 per year beyond Social Security, hold $120,000 to $200,000 in Treasury bills or money market funds. Yes, this will reduce overall returns in bull markets, but it prevents the catastrophic outcome of being forced to sell stocks during crashes. Third, focus on quality over yield. High yields often signal high risk. A 3% yield that grows at 6% annually becomes a 6% yield on your original cost within 12 years. That beats a risky 8% yield that gets cut. Fourth, do not ignore inflation. Dalio witnessed this firsthand in the 1970s. A neighbor retired in 1973 with what seemed like substantial savings. $30,000 per year felt comfortable. But inflation averaged 7% annually through that decade. By 1980, his purchasing power had been cut in half. What bought groceries for a month in 73 only bought 2 weeks' worth in 80. He had not spent recklessly. He had not made bad investments. Inflation simply devoured his standard of living. He ended up going back to work at 71, not because he wanted to, but because he had to. At 3% annual inflation, prices double every 24 years. Your portfolio must grow enough to outpace inflation or you slowly get poorer. If you want to model different allocation scenarios, Portfolio Visualizer and Portfolio Charts are free tools that let you backtest exactly what we're discussing. Links in the description. Play with the numbers. See how different structures would have performed through 2000 or 2022. Let me close with what matters most. When you are young, you think constantly about accumulation, building the pile, growing the numbers. As you get older, if you are paying attention, your relationship with money changes. It becomes less about the numbers and more about what the numbers enable. Freedom to spend time as you choose. security for people you love, ability to contribute to causes that matter. Dalio once said that the biggest mistake people make is not failing to get rich. It is getting rich and then losing it right when they need it most. He has seen it countless times. People who did everything right for 40 years then made one or two catastrophic decisions in their 60s that destroyed everything. The strategy outlined here exists to prevent that tragedy. Not to maximize your wealth, but to ensure that the wealth you spend a lifetime building actually serves its purpose, supporting you, protecting your family, creating meaning. If you have accumulated meaningful wealth by 60, you have already won. You do not need to keep score anymore. You do not need to compare returns to benchmarks. What you need is a strategy that protects what you built, generates the income you require, and lets you sleep at night. Capital preservation, simplicity, income focus, strategic inactivity, and legacy planning. These principles provide that strategy. Time is the one asset you cannot get more of. Do not spend your remaining years stressed about money. Build a portfolio that lets you sleep at night, then focus on what actually matters. The greatest investment you can make at this stage is not in markets. It is in relationships, in experiences, in contributions that create meaning. The portfolio exists to support that investment. Never let it become the end rather than the means. If you found value in these principles, there is more. Dalio's thinking on economic cycles, on diversification across currencies, on what happens when debt becomes unsustainable. Those videos are linked on screen now. And if you want this type of analysis in your feed, subscribe. The algorithm only shows you what you ask for.